Stephen, I've gotten a question a lot lately, and maybe you have too. And my own kid phrased it this way. He said, "Why are you ignoring the impending real estate crash that's surely coming down the road?"
Yes,
Do you get that question?
I get that question quite often, and I actually have some clients that are sitting on the sidelines who were ready to buy and then decided that they were going to hold off because there's a crash coming, and they think it's because we're going to have a repeat of 2008. So I think it would be important for us to go through actually what happened in 2008. And I was just getting out of high school. So you were doing loans. Enlighten us what actually took place in 2008 that caused the real estate crash.
Well, and it's interesting when we ask people like, "Hey, why do you think there's an impending market crash?" And the very first reason they give is the rapid appreciation during COVID.
Yeah.
Right? And which is similar to what we saw in 2000, 5, 6, 7. And it really started in the early 2000s. There was a government mandate, hey, we need to increase homeownership in America. Right? So if you've got a limited number of people that meet the loan requirements to get a house, what do?
You just have to figure out a way to lower the loan requirements.
Right. You got to set the bar lower, and which is exactly what they did. And it was a lot of people say it was the investors, or the mortgage guys, or the government, or whoever created the problem. But the battle cry was, we need to increase home ownership in America. And so in the early 2000s, they came out with some options. I worked for a broker that we could do a loan down to 560 credit scores with zero down payment, and you didn't have to tell me anything about your income or anything about what you had in the bank. Do you think that was a good idea?
Probably not. And I think that's probably what caused foreclosures.
Yeah, possibly. So, I mean, and this is exactly it. Like if I come, you want to sell me your car. And so I'm like, okay, yeah, sounds great. I'm going to make payments to you. But I have a really bad history of making payments. And I don't want to tell you anything about my income. You just make up whatever number you want. And I may have money in the bank, I may not, but I'm not telling you.
That is wild.
It was wild.
Yeah, and you were telling me also that, like, let's say, for example, somebody told you that they made $50,000 back then, and you said, the loan officer would effectively say to them, well, we can't qualify you for this house at $50,000, so we're just going to scratch that out and make it 100. And there was no verification of that like we see today.
Yeah.
That can't be true. Is that true?
Well, it was. And what was going on, the stated income loans, it was supposed to be stated by the customer, not the loan officer. But what was happening was they would say, oh, I make, 60 grand a year. And it's like, well, you really need to make 70 to qualify. And sometimes without even telling the buyer, they would change the income to make it qualify on the loan, which, if you're setting it up thinking you're making this much and you're making this much, it's less likely you're going to continue to pay that mortgage. Right?
Exactly.
And we talked a little bit about possibly the worst idea ever was what they called it, the pick a payment mortgage. Now, I had an investor who did dozens of these things, and he managed it well. He watched it, he kept track of it, and he to this day has never had a foreclosure.
Oh, wow.
So, but the idea of this loan program was your mortgage statement would come. This is the old days, when you actually got a bill in the mail.
Yeah.
Right? And it would have 4 options. Your first option was your 30-year mortgage payment. Your second option was your 15-year mortgage payment. So now, bear in mind, nobody chose those 2 options. But they would typically choose interest only, which means you're just covering the interest due from the last time you made a payment. So, interest accrues on a mortgage since you make your last payment, every 30 days or however often you make your payment. And so that option was just pay that interest. Your balance would stay the same, but you'd keep on paying the interest. It would never change. The balance would never change. Option number 4, let's say that the interest due is $500. The minimum payment might be $300. So you're not covering the interest. So they just add it on to your balance.
Right.
So your balance actually, instead of going down like a traditional mortgage, goes up. They did this a lot in California. So if you can imagine, you buy a house with nothing down and you have 4 payment options. At some point, that loan becomes a fully amortizing loan. Sometimes it was 5 years or 2 years down the road. Sometimes it was 10. So if you never make a payment on your balance, and then all of a sudden it becomes a 20-year loan where you have to pay the principal and interest, your payment goes.
Through the roof.
Yes. So all of this started in the early 2000s, 2002, 3, 4, and all the subprime lenders that we all hear about came about.
Yeah.
And so what do you think happened?
Well, I think a lot of people got foreclosed on because when it came time to actually pony up the dough and pay that principal and interest, and it's accrued over time because you've only paid the minimum balance for so long and you couldn't pay that money, then you would get foreclosed on. And this is just from my personal experience. As I said, I was just getting out of high school at the time, but I did observe a lot of my friends' family on the block all sort of in a couple of month period of time get for sale signs put in their yard. And it wasn't because mom and dad wanted a bigger house. It was because, unfortunately, they were being foreclosed on. And so what happens when you have a house that's worth $500,000 and you're the neighbor to the right of you and the two neighbors to the left of you all get foreclosed on, and the bank sells their home for effectively pennies on the dollar? What do you think happens to the valuation of your house? It tanks. And so you had a situation, and I was talking to my dad about this. He knew a lot of people that would take the keys to their house. They would get everything out of the house. They would take the keys to the bank, hand them to the banker and say, don't bother foreclosing on me. Here's the key to the house. Good luck and God bless. And so that's, so the banks ended up with all of this inventory and not nearly enough buyers. It drove the prices down. And that's kind of why, I think it's really important that we compare and contrast. You gave the color for what happened in 2008.
Right.
And that allows us to have the conversation about why 2025 is different. One, you had this massive mandate for home ownership put into effect by the Clinton administration, which basically allowed everybody to buy a house regardless of income, credit, all the sufficient due diligence that's needed to determine if somebody can buy a house. And you had all these investors buying with zero money down. And then all of these loan programs all of these loan regulations got put into effect when the 2008 crash happened. So what's different now? Let's say I come to you and I want to buy an investment property. How does that process look different compared to 2008?
Well, and that's an important detail. Back then, you could buy an investment property, stated income, stated assets, and nothing down in another state.
Yeah.
And it didn't matter. And so a lot of that stuff, as things came crashing down in 2008 or so, 9 and 10, a lot of that stuff, nobody had any equity.
Right.
Had zero equity in the property or negative equity in the property. In other words, they were underwater.
Because they're only paying that minimum payment.
Exactly. Now, to be clear, at any given time in the real estate industry, there is a small percentage that's underwater on their mortgage. But it's because they didn't pay their taxes, they didn't pay their insurance, or, they're way behind. Like, those are reasons people get underwater on their mortgage. Or they forgot to insure it and the house gets destroyed, stuff like that. This was much different. Now, as we look at what happened during COVID. So during COVID, there was massive demand, but there's also massive supply.
Right.
Because now you could get a mortgage at 2 or 3%. Everybody and his brother wanted to move. And then you had COVID. So COVID came along and said, hey, you can't go outside anymore. You can't go to work anymore. You've got to work from home, and your kids got to stay home too. And so families started to look at each other and go, you know what? I like you, but not that close to me.
Right.
So I need to buy a bigger house. And I need to buy a house with a pool and a backyard or whatever. And so all these folks, moved. They bought the house that they always dreamed of, or whatever it is, so that they could accommodate this change in our culture.
Right.
And so, all of that happened. We saw a massive increase in value. And then as rates came up in 22, all of a sudden it slowed down to leading to 24, which was, the slowest real estate sales year. However, all those people that bought during COVID, the value went up. And something like 60% of mortgages in the United States are under 4% now.
Yeah.
And so you think like, okay, if I've got a house at 4%, I've got 20% equity or something. If I lose my job, what's the worst I can do? I could sell the house. I have enough equity to cover the real estate commissions, and I got a little change left over to go buy the next one or go rent a place or whatever I've got to do.
Exactly.
And so the foreclosure rates and the delinquency rates, the subprime delinquency rate in 2008 was like 26%.
Yeah.
And it was 7% on regular, conventional mortgages. Now it's like 2.8, 2.6% on that are 30 days or more, 30 days past due.
Right.
And then the ones that are reaching foreclosure is a very, something like 0.07% of mortgages are in foreclosure right now.
Yeah.
And it's not the same. So now, interesting statistic. So let's say everybody that's in foreclosure right now, or everybody that's more than 30 days past due right now, gets foreclosed on. All those houses will be snapped up. You know why?
There's an inventory shortage.
Yeah, like 2 to 5 million home inventory shortage right now. Everybody could get foreclosed on that's past due right now, and we still wouldn't have enough homes to meet the shortage,
Right.
to overcome the shortage that we have. So when you have equity in the house, you have an affordable rate, affordable mortgage payment, then you have no reason to go to foreclosure.
Right.
You have tons of options. Whereas if you have an investment property, say you bought a 4-unit investment property 3 states away, and you didn't verify your income, or worse yet, your loan officer made it up. You didn't verify your reserves for mortgage payments should things go wrong. And then all of a sudden now the entire neighborhood gets foreclosed on, and your $300,000 investment property just became worth $150,000.
Right.
Now what do you do?
Yeah. It's a really tough thing to try to navigate if you're that investor.
Right.
And I think a couple of key things to me that really differentiate 2008 to today, where a lot of people think that we're going to experience another 2008-like crash. You mentioned the amount of homes that are in, well, I guess that would be considered pre-foreclosure. They're 30 days past due. They probably haven't gotten a letter yet, but one could be coming if they don't make up the back payments that are in arrears. That was at 250% higher than it is right now. So you have way more homes that are on the verge of foreclosure. And as you mentioned, the 26% in the subprime, that's 1 out of every 4 houses subprime.
Right.
Is on the chopping block, essentially. And then the other thing that you mentioned as well, the inventory, even if all those houses got foreclosed on, we still don't have enough inventory. And that's why prices have been remaining stable, even though we're in a 7% interest rate environment. And the average entry-level home for across the United States of America is over $400,000. And the disparity between what's the average household income and what's the average household sales price has never been higher. We're still not seeing home prices drop because we do have the inventory shortage. And as you mentioned as well, more than 60% of people have an interest rate of less than 4%. So they stand to make, and they have good equity in their home, they stand to make money when they sell, and that's going to keep everything propped up.
And I should add one thing, and that is that we are starting to see more activity. I mean, I'm starting to see more activity. I'm pretty sure you are too.
I am, yeah.
But what we see happening is, these people have been waiting for, 2-3 years, but they still have extra kids in their house sharing bedrooms.
Yeah.
They still have, they want to move because they need more room, or they want a pool, or they whatever, maybe they need to move closer to their job because a lot of people are called back to work.
Yeah.
So there's a lot more people out there that have been kind of waiting on the sidelines. So if in a normal market, you have demand that's like this, now we're a little bit above because we have some pent-up demand from all those people waiting.
Right.
Now there's low inventory still, so there's not a lot of options to buy, and certainly not at the options maybe that they want.
Exactly.
So what we're seeing is an uptick in the market, which is still supporting the value. If people weren't buying houses at all, right, there's no demand, then prices go down.
Exactly right.
But that's not what's happening. What's happening is people are buying homes at a rapid enough pace to keep those values climbing and climbing over time.
Right. And I think it's
not the rate they were before.
Exactly. And I think it's important to note too that when people see a dip in home prices, which we saw towards the end of 2024, they want to categorize that as a crash. A crash is, what was the percentage on average that home values went down in 2008?
Good Lord. I mean, in some neighborhoods it was 50%, some it was 20%, some it was 25%. It was a lot because,
Right.
and you have to talk about how appraisals are done. If you're buying a house, your appraiser is going to go find, three other houses that sold in the same neighborhood within the last 6 months. Now if there aren't any in the neighborhood, they got to go out of the neighborhood, maybe a little longer than 6 months, whatever. But usually foreclosures and distressed sales, as they would call it,
Yeah.
are basically ruled out. But what if those are the only sales you have available?
Then that's the only comps there are to go off of.
Right. And so that's what was happening. I had more conversations with agents telling me, you can't consider foreclosures. And I had to say, like, well, look, I mean, that's all there is.
Right.
We don't have any other options. So that is the market. People are buying houses at this price, and that's why. Now, it's important to note we're here in Houston, Texas. We've been lucky enough not to ever see a value decline except for 1 year. It was 1983. It was right Hurricane Alicia and the oil crash was going on at the same time.
Yeah.
And so we saw a slight decrease in value. It's like 1%.
And so that's been over 40 years ago. Every single year thereafter, we've seen increase in value.
Yeah, exactly. It may be just a little, but it's increase in value.
Exactly. And I think that's, and it's important to preface and say that, both of our crystal balls are busted. We don't know what the real estate market is going to look like tomorrow, but I think you can make an educated guess. And I think that you could, if you look factually 2008 to now, you can determine reasonably that we're not going to experience that 40 to 50% decline that you saw that was categorized as the crash, because that is a true crash. Now, could we see, like, for example, if you watch the Zestimate and you believe in the accuracy of a Zestimate about as much as I do, it says my home is worth 1.5% less now than it was 6 months ago. That's not a crash. Basically, in 2020, 2021, you had people offering $40,000, $50,000 over asking price, waiving the option period, all of that. That is an abnormal market, just as much as 2008 was an abnormal market in the other direction. So what we're seeing right now is not a crash. We're seeing the ebbs and flows of the real estate market, and people are panicking and calling it a crash. And I think that's an important distinction to make.
Yeah, exactly. And, I think the other thing that's going on, and I remember, when I bought my first house and sold it 6 months later, and the real estate agent's question was, well, what have you done to increase the value? And I'm looking around, I'm going, well, I added that light fixture, and we painted this room, and, it was not a whole lot.
Yeah.
And I'm like, but it should be worth more, because I live there.
Right, yeah.
Which is a common belief.
We have memories in this house. This has got to be worth something.
Yeah, I mean, your house is worth more than the next guy's because it was your house. You're attached to it. And so a lot of what has been going on is, especially as we came out of 20 and 21, is people were asking this much for the house when it was probably only worth this much.
Right.
And so, and some of that's still going on. And so people are, they're pricing a little bit high. They're never going to get it. You go to listing appointments all the time.
Yep.
You ever had a buyer or a seller tell you like, oh, well, I want to list it for this. And then you have to break it to them that maybe that's not going to happen?
All the time. Almost every time. It's the rare occasion when you meet a seller that's like, look, here's what I think the market value is. I'd like to come in a little bit lower than that. And I think that I'd like to get it sold quickly. And this is a fair value. That is the rare exception. And I will tell you that not so coincidentally, those are always the sellers that end up getting the most money for their house.
And you know what I'm telling people now? I mean, we get so involved in the weeds and the numbers and what's going on with the Federal Reserve and all of that. The reality is people are buying houses not because the Federal Reserve is doing whatever. I mean, they're not thinking what Chairman Powell is thinking as they're looking at that house and figuring like, okay, the furniture can go here, and this is this kid's room, and this is this kid's room. I mean, the whole idea is so they can get to the next chapter of their life story.
Right.
And these days, I mean, if you're able to qualify and able to afford the house, which in a lot of cases is cheaper than renting,
right?
Go buy it.
Yep. And I think that's a perfect place to leave it.
That's right. Go buy it.
Yep.